Hey everyone, welcome to the webinar today. I'm just going to give a few minutes for everyone to get started, or to file in before we get started, sorry. Give it another minute or so. Just have some late arriving people, and then we'll get started. Awesome. We'll go ahead and get started now. Welcome everyone to today's webinar. Thank you very much for joining. Today's webinar is hosted by Occupier, and we're also joined with our friends at Baker Tilly. The topic of today's webinar is From Spreadsheet Chaos to Compliance Confidence, the Controller's Guide to Audit-Ready Lease Management. We're going to be discussing quite a few things today. First off, we will be doing some intros and some general housekeeping. We'll then go through an overview of the accounting standards, primarily ASC 842. Third, we will cover some hot topics, so some predominant accounting problems that a lot of controllers are going through post-adoption of ASC 842. Throughout the presentation, where applicable, we will also be showing you a high-level demo of Occupier, kind of demonstrating some of the concepts we're going through. We do have a special offer to go through, and then we will wrap up with some Q&A. So as we kind of go through the demonstration and the webinar here, please feel free to post any questions in the chat. And then we will also, in addition to that, we will also have a Q&A at the end of the webinar to wrap up. Quick intros here. For those of you who do not know me, my name's Austin Robello. So I'm a senior solutions consultant here at Occupier. My main duties are helping with the pre-sales process, in addition to the post-sales process, serving as the accounting subject matter expert when it comes to lease accounting. So any technical questions, anything like that, I'm the go-to man here. And then I'm also joined by Phillip and Chazz here. So I'll let Phillip kick off the intros on the Baker Tilly side.
Yeah, thanks, Austin, and looking forward to a good presentation today. So my name is Phillip Massari. Both Chazz and I are former Moss Adams. We merged with Baker Tilly in June of this year, so we are full Baker Tilly at this point. I've been at the firm about 15 years now. I focus predominantly in the restaurant and fitness space, but also do a lot on the retail side of things. Goal in the next couple of years is to work to lead up the entire restaurant practice at the firm, and looking forward to what's ahead with this merger. So I'll kick it over to Chazz.
Thank you. So like Philip said, we've been working together quite extensively. My history, I've been in public accounting for about 7 years. I'm also an auditor specializing in the restaurant and also specialize in the fitness space. And my goal is to continue to help our clients be a partner more so, offer more practical advice on how to do their accounting, as well as help Philip lead the restaurant practice in the future years. Great to meet y'all.
Awesome. Thank you, gentlemen. Moving forward, just as to kind of level set here, so what is the state of lease management in 2025? So in general, why does lease accounting demand so much attention from controllers, CFOs, and finance persona in a general sense? So these are a few quick stats that we've kind of sourced from a lot of our clients and kind of general know-how of the industry. Today, 60% of companies are still managing leases in spreadsheets. For such a complicated standard, a lot of data, a lot of processes, a lot of complexity. A lot of people are still struggling and being bogged down by Excel. There's a lot of automated solutions out there. Today, we're going to kind of go through some of the hot topics and how we can help you with those transactions. The average controller still spends around 40 hours per quarter on lease accounting. So even if you adopted a software, people are still bogged down in the weeds. There's a lot of complexity to it, a lot of volume, a lot of demand, a lot of data. And lastly, audit findings have actually increased 300% since ASC 842 adoption. So although we are in year 3 now, hard to believe, of ASC 842, there's still a lot of accounting findings as people still haven't fully wrapped their head around the new pronouncement. And day two accounting is entirely different than the initial adoption. There's amendments, there's all sorts of different things that we're going to go through today and help you hopefully avoid some of these audit findings that potentially could happen in the future. I want to now turn it over to Chaz to kind of go through some of the real world consequences and what we saw during the audit season in 2025, so last year.
Yeah, I mean, I could corroborate what Austin just mentioned. Our clients tend to spend a lot of time accounting for ASC 842, and truly there are a lot of implications and significant inputs that require communication across departments. One thing I wanted to start with, and we're not going to stay here for very long, is just a little bit of background on the standard, just as a refresher, and then we'll get into, okay, but how do we account for it on a go-forward basis? Before getting into 842, let's have a quick history lesson. The previous leasing standard was ASC 840, and there were two types of leases, operating leases and finance leases. Operating leases were historically accounted for off balance sheet, which means that when the lease payment was due, the company would simply record rent expense with an offset to the balance sheet, either cash or AP, in some cases, even deferred rent. Capital leases were always capitalized as an asset and liability on the balance sheet and amortized over the life of the agreement. Interestingly enough, this standard actually dates all the way back to 1977. Now, ASC 842 got introduced in 2018, and as y'all have probably already gone through, required a lot of work. It's a lot of bandwidth to implement ASC 842. And the question that I'm sure you were asking yourself, and I ask myself every year as an auditor, is why are we doing this? This is a lot of work to get, some large assets and liabilities on the books. And to answer this question, it really comes down to the fundamentals of accounting and how it evolves, interestingly enough. Accounting standards change to address evolving business practices, new transactions, and the needs of the users of the financial statements. These changes ensure that financial information remains relevant, reliable, and comparable across different industries and jurisdictions. So, in short, we need accounting to reflect current day business so the users of the financials can make informed decisions. At the end of the day, businesses over the past several years have been renting their land, buildings, equipment, and other necessary assets to generate cash flow. In a significant amount of cases, most of these rental agreements fit the criterion of an operating lease, and users of the financial statements had little to no insight historically of the company's right to use these assets or liabilities associated with them, i.e., all those future payments that the company signed up for. ASC 842 was introduced to solve precisely that problem. Businesses are now required to capitalize the right of use asset and lease liability on the balance sheet, regardless of it being an operating or finance lease, as we call it today. That's just a little bit of background, a little bit of a history lesson, and the most significant inputs, as y'all may be aware, are, the start date of these leases, end date, the term, the discount rate, and then any potential tenant improvement allowances or variable expenses. Those are the significant inputs that we have to think about on a go forward. But with that background, I think we can go past this slide, go into the next one. There's a dual model approach, as we discussed, and I'm not going to stay here for too long, but you have two types of leases now, operating and finance, but both, and this is the most important part, both are on the balance sheet. for the users. Um, so let's move forward. Y'all have most likely implemented these leases already gone through an audit. Those audit findings have already came out. So, from our perspective, when we deal with our clients and when we talk to our controllers, we ask them, what are some of the things that keep you up at night as it relates to leases outside of just the accounting? And how could we help? So now that implementation is over, we need to maintain the standard of accounting, which opens up more opportunities to stay efficient. Like we talked about before, practical auditing is where me and Philip lie. Um, Based on our experience with our clients, alongside with Occupier, we came up with these 5 questions that keep finance teams up at night, and we'll start with the first one. We want you to walk away. Well, let's start with the first question. What is the lease commencement date? We want you to walk away knowing that the commencement date is not always the date that the lease was executed, but it is always the date that the company took possession of the lease. Keep in mind that possession date does not always correlate with the date of construction, let's say, assuming a location is a new build out. A quick story on that. I have a client who is in a growth stage and requires a significant amount of build outs before they assume responsibility over the lease. It was a fitness club, so you can imagine the inputs to that, HVAC units, etc. I noticed that at the end of the year, when we were doing their audit, that they had around 10 locations that were slated to open in Q1 with lease agreements executed. So using my auditor hat, I immediately went to go check to see if these leases were capitalized and noticed that they weren't. So I went over to the controller and I asked, hey, should these be capitalized? And if not, why shouldn't they be capitalized? And he was able to quickly show me in the lease agreements themselves, there were stipulations as far as it relates to the delivery date of the lease. And within the lease agreement, the delivery date stipulated that the company takes possession once the construction was substantially complete. And at that point, construction was not substantially complete, so they were completely right in not capitalizing these leases because they had not taken possession. So when you think of commencement date, always think about when did we get the keys? When did we take possession of this lease? And that should steer you correct when you talk to your auditors.
Yeah, and just to jump in there too, I know to kind of ditto Chazz's point, this is an area where a lot of occupiers customers struggle, especially because that, to your point, Chazz, when is construction actually substantially complete? Oftentimes, that's not a cut and dried like um, definition. It's very judgmental, which again kind of backs into the auditing that. You actually have to look at the facts and circumstances surrounding it and actually go back to your client's choice to capitalize or not capitalize and actually make an assessment on that. So it's not always cut and dry, black and white. There is some professional judgment involved, and anytime that happens, it opens up a whole other can of worms in terms of is it correct? How do you audit it? That sort of thing.
Perfect. So the next question that we get a lot, or what was on our controllers' minds was, how do I know I accounted for all the leases that the company has executed? Some companies do silo their departments where the accounting department operates independent of the operations department. So going back to the question, how do we know we got all of them? Especially with a company of size that's growing, let's say over 100 locations, it's not always a simple problem to solve, and it's not always a simple answer to this question. However, the path to the solution is fairly simple and resides in the accounting department just being in frequent communication with operations, and more specifically, if it's available in your entity, the real estate folks. My clients that do this well typically have a control in place where the accounting department meets regularly with the operations department, and one of the talking points is to discuss recently executed leases and construction build outs. During those meetings, my clients get an understanding of these leases and can quickly identify if they should be accrued or not under ASC 842, or they just give me a call, one of the two. But at least they have the information because they're discussing with the operations department. So that's one tidbit for you. Okay. So moving forward, implementation's over. What a lot of my clients are going through, especially the ones in a growth phase, are a lot of lease renegotiations. And given where we're at in the life cycle of 842, I'd imagine this is a common issue that a lot of y'all are going through since my clients are going through it as well. When we think of lease renegotiations, we really bucket them into two types. It's either a lease modification or a lease termination that's associated with this renegotiation. So let's start with lease modifications. So a lease modification, just quick definition here, is a change to the terms and conditions of a contract that result in a change in scope of, or the consideration for a lease. So here's some examples here on the slide, but truly in the industries that I operate within, restaurants and fitness, we typically see two types of modifications. One, it's either an option period renewal, or two, there's a general change to the lease terms. Maybe the lease term was shortened or payments increased marginally. And that's what we see in practice. And both scenarios that I mentioned, typically we advise our clients to remeasure the lease at the point these agreements are executed, whether it's the renewal or the change in lease term. We're going to go through an actual live demo of remeasurement within the Occupier system, but for now, that's what we typically see when there's a lease renegotiation. The first thing on your mind should be, is this something that we need to potentially remeasure? So let's move on to the next slide. Um, just going to present this one for you. This is a good one probably to take a screenshot of. But how do I account for a lease modification? So really, you're going to remeasure and reallocate the remaining consideration in the contract at the date of execution. You'll reassess the classification. Typically, it stays the same from what I've seen, but you'll reassess it at that point as well. And then if there's any initial direct costs or lease incentives that derive from that change in lease term or renegotiation, you're going to want to account for those in the remeasurement itself. One could be potentially a tenant improvement allowance for an extended lease. Maybe that's a concession the landlord is offering. That tenant improvement allowance would need to be captured within the remeasurement. Um, and let's say we get into termination land, which we won't talk too deep on here. Um, you know, sorry, one second. If an existing lease is terminated, you're going to want to remeasure the lease liability, very similar to if they change the lease terms. And the biggest hit's going to be around adjusting the carrying amount of the RU asset by the amount of the remeasurement of the lease liability. So those are the two ways that you would account for either a modification or a termination. We can move on to the next slide here. So as it relates to accounting for a lease termination, a lease modification may reduce the scope of a lease through a full or partial termination in some instances. These are a couple examples. Reducing square footage may result in a reduction, maybe removing a lease component, like you had the office space and the banquet hall, but now it's just the banquet hall. Those should be treated as a lease termination, in whether it's a full or partial termination. In practice, here's what we see. So if you have remaining liabilities, payments, or termination costs, you just need to make sure that the liability agrees to the remaining future cash outflows. From what we see, these leases are terminated in the system, and any remaining liability and accounting for that liability occurs directly within the GL. This is slightly different than leaving the lease liability since the lease liability is discounted, but ultimately you should have a liability for the remaining cash outflows to be made. That's how you account for the lease termination. I'm going to pause here and maybe we can move into how does this work within the occupier system now that we've talked more theory.
Awesome. Thank you, Chaz. We obviously uncovered quite a bit there. I'm going to more so focus on one of the transactions that we kind of went through. So I'm in the Occupier platform here. Some, if not all of you are probably familiar with the platform, but I'm just going to quickly kind of highlight how I would go through a remeasurement or modification event within Occupier. So as you can see here, I have my Baker Tilly headquarters. If I click into the actual measurement here, you'll see that this lease started back in 2022 and is due to expire at the end of this month. if my real estate team, let's just put out a hypothetical situation. If my real estate team informed me as the controller of Baker Tilly that they went and renegotiated and renewed our headquarters lease for an additional 5 years, I could easily manipulate my occupier data and actually account for that in a matter of a few clicks, as you can see here. So I'm just going to click add a new measurement here. The first thing you'll need to do is define when you were informed of that information. So when that renewal document was actually drafted. I'm just going to say it was on December 1st of this year. And then you also need to update the expiration date. So in my example, I said we extended it out another 5 years. So in that case, I'll update the expiration date to 2030. As you can see here, there's an option to change the payments, add any incentives that were negotiated in, kind of all those topics that Chaz hit on. For simplicity's sake, what I'm going to do is I'm just going to say the rent increased to $10,000 a month and then just keep it flat. And then what I would primarily do, I'm going to assume there's no incentives that were negotiated into the renewal, but what I'm also going to do is update that discount rate because generally that's what you would want to do. And then we're just going to assume that the lease remains operating in nature. Once I actually click submit here, what you're going to see is that Occupier is going to take a second, and then it's going to actually render and calculate that modification event for me. So you can see down here, it's actually adding on $550,000 in terms of a new right of use asset and a corresponding increase to that liability. If I flip over to the journal entries here, give it a second. You can see that if I scroll down to December of 2025, you can see here that it's actually bumping up my asset for that 557,000. And then there's also a corresponding adjustment to my liability. To Chaz's point, to remeasure that lease for what the actual obligation is in terms of adding on that additional 5 years. We will now hop back into the presentation, and we're going to turn it over to Baker Tilly again to go through what your auditor is actually looking for in terms of the end of the audit. So those financial statement disclosures, which can sometimes be pesky and kind of hard to wrap your head around.
Perfect. Yes, so y'all have probably already gone through an issuance of financial statements with the 842 disclosures, so we won't stay too long here. But really, the disclosures under 842 require a decent amount of inputs, and these inputs create quantitative and qualitative disclosures. Quantitative including, weighted average discount rates, weighted average terms, and qualitative including accounting policy elections and significant judgments that the entity is making. We wanted to include just a couple examples just to show you how these tend to come to life. So this first tab or this first slide here is really the qualitative aspects that are required to be disclosed. Um, once you set these up, you really only need to tweak them if you enter into a lease that's different or you have different treatment than what you've already disclosed in previous financials. So this is probably set up for most of y'all. Really, the thing that I wanted to highlight was in the next slide, as it relates to the output that Occupier allows for. Really, these outputs help construct both the quantitative and qualitative, and they present the detail on an aggregated basis in an easy to read format that can allow either you or your auditor, if they're the ones drafting the financials, to quickly pull the information, tie it out to all the work that y'all have already done through the audit, and ultimately issue the financials. Within the next slide, these ultimately culminate into a full 842 disclosure. So this is what it looks like just in entirety. And then one more slide for me. That output from Occupier, those are the numbers that can easily be taken, and we just zoomed into the disclosure, it plopped right here. There shouldn't be a lot of manual processes going on here, and I do have a couple clients that are still doing it manually, to Austin's initial point, and it is always a very time-intensive exercise. So to have a system do it for you is always a benefit, which is probably a good transition into the live demo of how we do that in Occupier.
Awesome. Thank you, Chaz. Quickly, I'll run through how you would actually generate kind of what we just walked through in terms of the quantitative disclosures out of Occupier. So given that Occupier is system of record for your leases in general, has all that information, both qualitative and quantitative, generating the disclosures is actually super easy. And as a former controller myself, I know it took me probably 2 to 3 days out of the year to actually generate these manually. But in Occupier, as I'll demonstrate here, it's a matter of a few clicks. So if I was one of Chazz's audit clients, and I needed to prepare the quantitative disclosure requirements for the 2025 period. I could just come in here and filter my report as such. And then once I actually hit create report here, this button, what I'm going to get is a automated output out of Occupier, again, given that all that data is living in that system. What it's going to do is generate a quantitative disclosure workbook for you with all the supporting tabs. So this has your lease expense footnote, the cash flow information, those weighted averages that Chaz ran through, as well as that maturity analysis, which can sometimes be painstaking to prepare. The great thing about this, and I'm sure Chaz and Philip love this, is that it's all supported as well. So if I wanted to see how Occupier is deriving the amortization on the right of use assets as an example, all I have to do is pop into the corresponding tab down on the bottom here, and you can see all the transactional level details. So what lease that transaction stemmed from, and then what month it actually happened in. And then if you take the total of this tab, it agrees back to the footnote here. So very plug and play, very audit ready. So I'm going to now flip back over into the presentation here to go through some other considerations post-implementation.
All right, thanks, Austin. So what we did is we took a pulse of our clients over the last couple of years, and we tried to identify essentially all of the similar type questions we were getting from our controllers. So we have a couple of items here. The first and one of the biggest things we deal with are how do we account for lease incentives? So under the old rules, you typically accounted for those incentives as they occurred. What happens under 842, specifically when you're working in a system, is the guidance now requires you to estimate those lease incentives once you actually input the lease into the system. So what we see very often is some of our clients will know exactly what that number is at the adoption of the lease. So within the occupier system, there is a section you could put the tenant improvement allowance in, and it will help calculate it for you. In the scenario where you're just truly unable to make that estimation up front, it's totally acceptable to put the lease incentive in as you receive it. What that would require, though, is a lease modification in the system. And again, you would put in the TI within the specified box within Occupier to let that automatically calculate it. In theory, what this does is it reduces the value of your ROU asset. In turn, it reduces your straight line rent expense year over year. So that's a pretty big one. We see it pretty often. The next one is, how do I account for a lease that was input incorrectly? So we always love this question from our clients because what we see very often is our clients will identify that a lease doesn't have the correct terms in the system, and they will just go in and edit the terms. What that does, however, is it pushes the adjustments to all prior years that the lease was in the system. And if I put my auditor hat on, what we would call that essentially is a prior period error that potentially might require a restatement. So we're always trying to avoid restatements in our world. So what we always recommend is if you do input a lease in incorrectly, modify it when you identify the fix and just use the modification or remeasurement feature to make sure that that lease is correct on a go-forward basis. One of the next questions is how do I book the journal entries? Within Occupier and really any lease system that you're involved in, the journal entries from the system are typically going to always have you post your AP or your cash. Now, typically in practice, you've already paid that cash to the landlord. So what we typically see and what we recommend to our clients is you don't necessarily need to follow the journal entries from the system exactly, because it's going to potentially trip you up on the AP and cash side. But what we do is we say, run the amortization schedule for the full year, figure out what those ending balances are, and then true up your GL just based on those ending balances from the amortization schedules. So it'll hit your ROU asset, short-term and long-term lease liability, as well as any kind of straight line rent expense. One of the other questions we get is how do we include variable rent in our calculations? Well, to Chazz's point earlier, we like to audit in a more simple manner, a more practical manner. And so anytime our clients have variable rent expense, we always recommend to record those to a separate GL account. Within your ROU asset calculation, we typically only include the base rent amount. You're only supposed to include amounts that are fixed in nature and do not change. So let's also say that there's a CPI index within that lease agreement. When you're inputting that into the system, we don't need to worry about that CPI. That's going to be recorded in a separate GL as a variable rent expense. And within the ROU asset calculation, it's strictly going to be your base rent for each month. And what that does is it really just simplifies the accounting quite a bit for all of our clients. So this is one we see all the time. And then the last one is lease impairments. So we're not going to get into the nitty-gritty of how impairment is calculated or how it comes about. Chazz and I are happy to have any other calls after this for some impairment discussions. This can be pretty lengthy. But the idea here is if you have to impair your lease, what's going to happen is if we think about the journal entries, you'll debit some kind of impairment expense, and you're going to credit your ROU asset to zero. So what that does is it leaves your lease liability on the books because in theory, you still owe those payments. The impairment is strictly for the ROU asset. And once you take that one-time impairment expense, going forward, it's going to also reduce your straight line rent expense because the value of that ROU asset is now written off. And I believe Austin is going to show a demo of how to get this impairment done in the system.
Definitely am, Philip. Thank you. So getting back over into Occupier here, I have set up the Baker Tilly Southwest office. So again, let's put on our imaginary hat and let's pretend that for whatever reason, Baker Tilly's use of this office has changed in a substantial manner. And in advance of their 2025 year-end audit, they needed to make sure that the right of use asset was impaired in order to make sure they didn't have any audit findings, anything of sorts. So in order to actually impair this in Occupier, again, it's super simple given that a lot of the calculations and underlying data is structured. So the first thing it's going to ask you is what the impairment charge is. In a lot of cases with my customers, I've seen them just write off the entire asset. In this case, what I'm going to do is I'm just going to say I wanted to impair $50,000 of the right of use asset. The second question it's going to ask you is when you want to apply that impairment charge as of. Generally, with a lot of my customers, they do this, and under ASC 842, you have to assess for indicators of impairment at least once annually. Generally, that's done at the end of the year in December, so I'm just going to apply it as of December 2025. There's then an optional space where you can add a description of the impairment. It's not mandatory, so I'm just going to leave it blank. Once you actually hit submit, what it's going to do is it's going to, whoops, I need to add in a GL account for an impairment charge. I'm just going to put in, and then if I pop back over here, what you're going to see is this new impairment charge column populate. And to Philip's point, what you're going to see is that my right of use asset is essentially going to get written down $50,000, but you'll notice that my lease liability balance hasn't changed. And the reason for that is you're still obligated to pay that lease, as Philip mentioned. The use of that space has just changed, which is why you actually have to reduce the right of use asset. So that's how you would record an impairment in Occupier. Super simple, as you can see. So now we're going to pass it back over to Chazz and Philip to kind of talk through how you can glean some more information if you do have any questions out of with respect to lease accounting.
Yeah, I can take this one real quick. So, and we do have some questions in the chat, it looks like, so we'll address those shortly. But truly, if you would like any more information, here's just a couple resources. Under Heritage Moss Adams, before we merged, we did release a full-blown 842 accounting guide, and then of course we've got a reference to the FASB as well. However, like Philip and I have mentioned a couple times, and we'll probably close on this, is you want to talk to a practical auditor. That's usually an easy source. So we could also be in your Rolodex of individuals to call if you have a question here.
Awesome. And then just to add on to that, in addition to resources such as Baker Tilly, professional CPAs, auditors of sorts, there's also a lot of systems out there, such as Occupier. So Occupier is the only modern lease management and accounting platform that unifies both real estate and finance teams, which kind of Phillip and Chazz hit on a little bit earlier. Is kind of the number one critical component is being able to communicate real time with your real estate folks as a member of the finance team. So trusted data, portfolio visibility, being able to act proactively and not reactively, all results in being audit compliance ready. And as I mentioned at the outset, we do have kind of a special offer here. Nothing too crazy, but what we are offering is a complimentary lease portfolio assessment, whereby I would kind of meet with you quickly, go through your lease accounting portfolio, and go through a lot of the topics today, show you we can kind of do that with your portfolio within Occupier, and just in general, any other questions that you have. So we're willing to do that free of charge and kind of talk through anything that might be bothering you from a lease accounting perspective. And with that, that concludes the presentation. So we'll open up the floor to Q&A, and we'll do our best to answer anything that you guys fire at us. Sounds like there were a few questions that were already kind of populated in the chat throughout the webinar. So if Phillip or Chazz kind of want to take the ball with that, I'm happy to kind of open up the floor.
Yeah, I'll take the first question. It says,
Okay.
what process do your clients go through to identify embedded leases in service or supply contracts? So typically see two processes. One, our clients will take all their disbursements for the year, pivot it by vendor, and then look for recurring payments. Because typically that's how a lease would operate is recurring payments. Yeah, it might be marginally different every month, but recurring in nature. They'll target those recurring payments and say, okay, do I have any rights to an underlying asset here? Good example is a lot of our Baker Tilly invoices are meant to be recurring payments. We would pop up in that embedded lease search, let's call it. However, the controller would then say, well, this is a service. There's no underlying asset that I'm getting from Baker Tilly. Now, let's say there is an underlying asset, which we have seen in practice, especially on the restaurant and fitness side. Typically, it's not material. They might be hand washing stations or sorry, hand soap dispensers or, like a safe that is located within the individual restaurant locations. Yes, those are technically embedded leases, but there's typically an argument to say that they're not material. So that's what we see in practice there. The second piece, and probably an easier method potentially for y'all, is just to review new vendor contracts. So you've already done a search as part of implementation and most likely already have looked at other vendor contracts. I typically see some of my clients implement a control which just states if there's any new vendor contracts, we look for a potential embedded lease, i.e., the right to control an underlying asset. So either option has worked for my clients in the past.
And just to touch on that briefly, Chazz, you did mention the safes. And so in addition to those, what we've seen recently is a lot of our clients with POS systems are just paying for a service. We actually found a significant portion of POS systems that were not on the balance sheet that we had to capitalize pretty quickly once we identified those. So you also want to think about service type contracts where you do use an asset, some type of asset, but you're really only paying that monthly quote unquote service fee. So that's a perfect spot to look for some of these embedded leases that we need. Another question we got in the chat says, I've read the ASC 42 guidance and noticed that the discount rates don't always need to be adjusted in modifications or remeasurements. So I've actually spent a lot of time in the guidance on this topic because if you actually go into the guidance, it is clear as mud, as we like to say, very hard to understand. However, the big picture of this guidance wants consistency. And so it's safe to say anytime you change or remeasure a lease, you always want your discount rate to match the remaining term on the lease. There are scenarios where you will shorten a lease, extend a lease, and again, anytime you have a remeasurement, safe to say that discount rate should also be updated every time.
Awesome. Thanks, Chaz and Philip. At this point, we'll open up the floor to any other lingering questions out there. Those were two great questions and something a lot of the customers I deal with on the day-to-day definitely struggle with. So yeah, if there's any other questions, fire away. If not, I would like to thank everyone for joining us. We will circulate this slide deck and a few other of those resources that Baker Tilly kind of mentioned, their transition guide and all that stuff, as some follow-up items. So you'll have those at your disposal for the upcoming audit season. And then, yeah, if there's any other questions, anything like that, I'm happy to be a resource to you. Feel free to reach out to anyone, myself, Chaz, or Philip. Awesome. Doesn't look like there's any other lingering questions. So I think we're good to wrap up. Thanks everyone for your time, and we'll be in touch soon.
Thank
Thanks,
you.
everyone.